The real estate market crash of 2023 for the last couple months looked like it would never materialize, but the largest mortgage financer in the entire country just released a shocking report that details 3 reasons why it might be coming back to life, and this time it could dip us into a full-blown recession. In this video, we're going to break down whether that may or may not happen. We'll also break down why in Kansas City, homes are selling within hours of being listed on the market, and whether or not you can expect that to continue the rest of the home buying season this summer. Before we cover the real estate market crash, there's something that matters 10, maybe 100 times more, and that's the debt ceiling. If you're seeing this part of the video, it means that Congress still has not made any meaningful progress on passing a deal that would raise the debt ceiling, which is problematic because we're slated to run out of money by June 1st, which gives us less than a week until next Thursday when we default on our debt officially for the first time in over 200 years. And even though I'm not optimistic in Congress, and this is more out of just like desperation and my hope for the broader economy and the rest of the world, I really hope that they can get something together, even if it is the last minute, to prevent this from happening, because it would cause an immediate recession basically worldwide. So had to address the elephant in the room. Full video from last week that details all of this is down in the description. We're going to put a pin in this one as much as we can and move on to the other big problem that we've got, which is the real estate market crash. So Fannie Mae released this really boring report that details the scenario in which the housing market would actually push the broader economy into a full-fledged recession. There are generally 3 reasons why they're saying this is the case. Number 1 is that there is currently a record number of multifamily units, in other words, like apartments, townhomes, things like that, that people can move into and live in, that will come online later this year or earlier next year. Now, this is a really big deal because, as you very well know, there's a huge housing shortage, not just in Kansas City, but across the entire country. And since basically the housing market crash of 2008, there hasn't been enough supply keeping up with the amount of demand, which has just been increasing and increasing and increasing ever since then. And even though we've got a record number of multifamily coming online, it's nowhere near enough to match the current level of demand, which leads to point number 2. The problem is what happens after those are available in the market and people rent them out and move into them. Because right now, a lot of banks, as a result of the banking crisis and high interest rates, are really tightening their lending standards. And that's making it very difficult for these developers for single family and multifamily homes and apartments to actually get loans, commercial and industrial loans, to finance these big projects. So Fannie Mae basically says that there are going to be less home starts, which will lead to a gap down the road in the next 2 to 3 years, which will be really problematic because that gap between supply and demand is only growing over that time. Now, some parts of the country are going to be hit harder than others, but here in Kansas City, we're in the middle of like a housing drought. It is a complete shortage, and even to get an older home at this point, you're in a certain bidding war in a good school district, you're most likely going to go over asking price, and the same day that a lot of these homes are being listed, sellers are setting offer deadlines, which means all these homes are basically selling in 24 to 48 hours, at least the best ones, and it's really, really competitive. But imagine if that got worse. We've got a little bit of data from the month of April, which is when all of this craziness was really kicked into high gear, and it'll tell us a little bit more about what to expect the rest of this summer. So here's the data from April 2023 compared to April 2022. The big thing to note here is the bottom row. You can see that total inventory is up only 0.2%. It's basically the same as it was last year with 2 big changes. One is that pending sales are down 15%. Closed sales are down 20%. So there are less transactions taking place, but we have the same amount of inventory. And this is all happening despite the fact that monthly payments are twice as expensive for the same home as they were last year. Now, I've been tracking the month-to-month changes, and supply in Kansas City is so tight that for the first time in nearly a year, we have 2 3-month trends emerging. One is percent of asking price received is going up, meaning over asking price offers. Number 2 is a downward trend on the days on market, or the time to sell. And I can tell you that 38 days to sell right now for the best homes, that is not the case at all. They are going very, very quickly. And I know you're seeing the same thing on Zillow, Realtor.com, Redfin, Trulia, all of the search sites. Now, next month, it's projected that the Federal Reserve might either pause interest rate hikes, which would create downward pressure on mortgage rates and cause even more people to flood into the housing market. So it is totally highly questionable whether this will continue, although I can tell you that the longer the summer goes on, the closer we get to the early fall, so late September, early October, the more inventory there's going to be, so more homes that you can choose from, and the more competitive of an offer you can write, even if it is under the asking price. But don't quote me yet on that one. I can also tell you that a lot of my clients who are interested in new homes and building homes, they're having a lot more success with new homes than is even possible with older homes. For the most part, they're not getting multiple offers, and there's also a little bit of wiggle room to get incentives and credits at the closing table. So for more information on that, all my contact information is below. Go ahead and send me a text, phone call, or an email, and we can talk about exactly how you can take advantage of that opportunity with new homes. Now, it's kind of shocking how this all ties into that Fannie Mae report, but even they say in this part of the article that even though there's positive momentum from new home construction, it's unlikely that continues. They also say that consumer spending is so unsustainably high, they believe a modest recession is the likeliest outcome of all of this. But I do want to make it very clear that this is just one prediction from one group of economists who think one way. And the same is true on the opposite side of the aisle with Zillow and even CoreLogic, which CoreLogic happens to be the biggest data provider. It runs the MLS, Zillow, Redfin, Trulia, all the real estate data that we have in the entire country. And they predict that home prices across the country will rise by about 4.6% this year. Now, Zillow, on the other hand, predicts, according to this graph, that in Kansas City specifically, we should see home prices grow about 5.1%. So while Fannie Mae says one thing that's kind of doom and gloom, that the housing market crash really isn't over yet, there are a lot of other big companies out there that are spending millions of dollars on all of this research that conclude the exact opposite. And here's the silver lining according to Fannie Mae. They say that housing remains exhibit number one for why we expect the recession to be modest. It continues to outperform our expectations, and we expect that its relative strength will help kickstart the economy into expanding again in 2024. In other words, this is kind of confirming a long-held narrative over the past year or so that we will most likely see a recession. It'll be a short one, and it's necessary to kind of restart growth down the road. So ultimately, we've covered both sides of the story. We have Zillow, CoreLogic saying everything's fine, we're gonna be fine, housing market's good. We've got Fannie Mae saying not so good, but we've got to have this recession because it's good down the road. So what do you think? Will we see that recession? Will it be short term? And how do you think it'll impact the Kansas City real estate market and home prices in Kansas City? Let me know what you think in the comments below. Of course, if you'd like to have a specific conversation about what all of this stuff means for you, and if you're thinking of buying or selling a home this year in Kansas City, all my contact information's down below. Go ahead and reach out. I'm the guy that answers. It's not somebody else. You're not going to be shuffled around to a bunch of different team members, and we can get that on the schedule and get you specific answers to all these questions. If you're in the market for a new home, we can also do that as well. A lot of people are having success with these and even getting tremendous credits and discounts, even despite the craziness with older homes. So go ahead and reach out for info on that. If you enjoyed the video, hit that like button, subscribe to see future videos, and I'll see you next week because it is bound to be an interesting one.